Good morning, everybody. It's nice to see you.
Hey, Sandy. Hi, Brandon.
Good morning.
For our listeners, we have Brandon Solomon with us today, joining us for this episode. And Brandon we're very lucky to have him. He is a senior vice president and general manager at Convey Health Solutions, leading operations for Pareto Intelligence, where he focuses on developing partnerships with health plan clients. That's how we came into contact with them, helping them attract, retain, and manage their members with advanced technology and analytic solutions. And Brandon's going to tell us a little bit more about what they're doing at Pareto right now. But I just want to speak to, prior to this role, Brandon was an original member of Healthscape Advisors, which was a leading healthcare management consulting firm, and Pareto before they merged with Convey. So Brandon has been working in this healthcare industry for 20 years as an advisor and partner to both health plans and providers, with a really strong emphasis on government markets, not just Medicare Advantage, but also Medicaid, Affordable Care Act exchange plans. And as you all know, that is, the bread and butter of what we cover here on Health Law Simplified. And I just want to say we got connected with Pareto a number of years ago through a shared client and had a really wonderful experience working with Brandon's team. They really understand not just the ways that risk adjustment helps plan performance, but also the compliance issues, which is not always the case, with different vendor relationships. We were so impressed with Pareto's compliance focus. It was, a real pleasure to work with them. So thank you
Yeah,
for joining us here
and I'll
today,
even add
Brandon.
to that, they were uniquely receptive to input from a compliance perspective, which we really noticed and appreciated.
I appreciate it and I'm flattered. We have a great team
So
here.
you do. So tell us, Brandon. I know I gave a little intro. What would you want to tell us about either Pareto or the work you're doing? What's your role there?
Yeah, and just knowing some of the topics that we're going to cover, I want to give a little bit of additional background. So, in addition to the dozen years or so in management strategy consulting, held multiple strategy and growth roles across Convey Health Solutions, which is our parent organization, mainly in the supplemental benefit space, which I know is drawing a lot of attention. So, though I'm no longer directly leading growth and strategy over supplemental benefits for Convey, I am still a member of the executive team over there and heavily plugged into what is going on in that market. So I know that's a topic that we'll cover. Within Pareto, we have kind of two service models. So we have analytics subscriptions as a service, and then we also have advisory services. The way I've always put it is we're deep experts in the areas for which we have analytics, and risk adjustment being one of those, STAR being another. And so you've probably heard me say complete, accurate, and compliant. That is always our goal and objective when it comes to risk adjustment and clinical documentation accuracy. So mainly supporting health plans. I would say 80% of our customers are health plans, but we have a growing number of risk-bearing provider groups that are taking capitated or delegated risk in Medicare Advantage, Medicaid, or the ACA. So a lot of the challenges that we've been working with health plan payers on are now directly impacting the provider in a very unique and challenging way. So excited to be on, longtime listener and first time contributor.
Thank you for speaking to some of those roles and giving a little preview as to some of the questions we have for you today. And I think I just want to start right off the bat with supplemental benefits. For a long time, Medicare Advantage organizations invested heavily in supplemental benefits. That was one of the distinguishing features from original Medicare. And it was a really effective means of attracting and retaining members. So really, the marketing benefit of supplemental benefits. we've noticed that seems to be changing. I think, you've indicated something similar. So can you tell us what changes you are seeing in the supplemental benefits landscape?
Yeah, for sure. So plans have been investing in supplemental benefits, as you mentioned, to attract and retain members, but also to manage members. And that was really the core thesis around it when CMS gave plans greater flexibility of which kind of benefits outside of traditional Part A, Part B covered benefits that they could invest in. Really with the focus to address social determinants of health. I think with the favorable advance notices that you saw back in 21, 22, 23, it really became a arms race to gobble up membership. And a lot of investments were made in the area to really differentiate. So we continue to hear from our clients, hey, we have to do this because we're competing against the nationals. And they're saying, here's a $0 benefit and you get this flex card and you're going to have $2,000 on it. If you have a rewards program, you can earn another $250. And I can't compete. I can't sell your product unless you have these benefits. But you fast forward, more challenging rate notices, higher utilization trend, both within sub benefits, but just broader Part A and B coverage. And greater flexibility and increased costs in Part D, MA plans can't afford it. So what we're seeing is plans eliminating what I'd say are kind of like the fringe benefits and just focusing in on the core. So your dental, vision, hearing, maybe OTC, food within the SNP area in particular. SNP sub-benefit investment is definitely different than individual, and you have to look at those two markets differently. But I do think plans are placing greater scrutiny on, is this actually improving health outcomes? Is it avoiding costs long term? And if it's not, I don't see it sticking around in the market on a go-forward basis.
That's a really good insight. We tend to think of supplemental benefits as fulfilling two purposes. One is frankly marketing, and you alluded to that, and that was really powerful, 5-6 years ago, kind of in the heyday when 2 million new people were coming into Medicare Advantage every year. But then the second is the care management, health outcomes. What I'm hearing from you is that latter purpose, which is really more important, is really what's surviving in this more cost-constrained environment.
Yeah, CMS is putting greater regulation out there. They're trying to collect data in order to understand the value and efficacy of these programs. Candidly, we had to have a lot of conversations with our client to be honest around what is their true goal and objective, and then align their measurement of performance and return on investment based on what those goals are. So if you're truly doing it for sales and marketing, let's not kid ourselves and say that we are doing this to reduce overall spend. And for those that are doing it, and I think a lot are investing because they have that conviction that these benefits do solve barriers to care and can reduce overall spend. But you have to have the right analytics around it in order to measure that and then prove to your actuaries, prove to your CFO that we need to continue to invest in these things.
Okay, so this is an unfair question that we didn't prep you about. If you could just do one thing, like one supplemental benefit in a general, not in a particular chronic SNP, but like what is the one thing that you think affects health the most in terms of supplemental benefits?
That's a really good question. So I'm going to set dental, vision, hearing aside because I don't view those as supplemental benefits in the same definition, because we've been investing as an industry in those for a long time, and I would probably just immediately pick dental. But as we think about the other category of supplemental benefits, I would have to say transportation or food, especially within the special needs area, it's such a barrier to access to care. And on the transportation side, and then on the food side, we saw it every single quarter when those dollars replenish within their card and their benefit. That first 2 weeks is when they use the benefit the most. And so it just speaks to the need. There's a lot of companies investing in food as medicine. This I view a little bit more foundational of just quantity and access to food. So I would probably pick those two. For the larger individual market, I think it just gets to member specific and what their needs are.
Thanks. That's really interesting.
So it's not the one FDA approved hemp derived protein powder that's now allowed with the new final rule authorizing cannabis benefits, but only if they're legal.
Don't knock it till you try it.
The robotic dogs people were investing in to solve social isolationism. There's a lot of those benefits that you saw, especially, having to be on the conference scene and you see all the new companies that pop up. It was amazing when you fast forwarded into 24 and 25, how many of them weren't there and how many of their people were just at other booths and other jobs. So it's, you have to have a long game conviction in these investments.
And can you speak to, sorry, let me rephrase. There is, I think, a big gap between payers and providers in knowledge level about these types of things. What do providers wish that payers understood about their practices when it comes to supplemental benefits or vice versa? What do providers need to know from the payer perspective?
Yeah, it's funny that you mention it because I got a call from a private equity firm that is heavily invested in primary care, fully delegated risk companies. And they were looking at their overall financials and are like, what the heck are these supplemental benefit costs that are coming through as med expenses? As a provider, they're taking full capitated risk for all Part C and D costs. They have no influence or say over the cost associated with supplemental benefits that the plan is making. And, without knowing it, it was an added cost that they didn't feel like they had control to manage, but were absorbing the spend. Beyond just the financial construct of it, I would say just gaining understanding and having an idea of what their patients have access to can really help connect the dots between the appropriate use of the benefits to address clinical need, whether, again, transportation, OTC, food, what have you. It just gives the provider more flexibility around how they can manage their patient and ensure they have the right access to care. So to your question, I think having an understanding and having transparency into what those benefits are and what every patient has access to is a real big knowledge gap that is easy to close.
That is really interesting. Excuse me.
Yeah, no, I mean, the second thing, and Sandy, I think we talked about this last week, but we would extend that over to the rewards and incentives programs too. So most Medicare Advantage plans, and we're seeing it become more in favor in the ACA and Medicaid market, have member level incentives for members to engage in complete preventative care activities. So this was legacy, HEDIS-based activities that tie to STAR measures, also the completion of annual wellness visits or virtual care and home visits. For providers that are struggling to get patients engaged, this is just a carrot that the plan has already put in place that when they know, they can use it to get the patient to engage and come into the office. So being able to piggyback off the programs that the plan's already put in place in order to get your patients to complete the activities that are necessary while also earning a monetary reward in doing it, is a win-win for the provider and the patient.
Thank you for sharing
very
that.
interesting perspective. What I was thinking, Sandy, is because we, folks might not know this, but we do represent providers taking risk in contracting vis-a-vis payers that we don't have conflicts with, specifically the large national payers. And that is something I had not thought about before, because when you're taking risk for medical expense and you're thinking from the provider perspective, you're thinking about claims expense and maybe drug if Part D is wrapped in. But that put a bee in my bonnet to think about maybe a cap on non-claims medical cost. That this, we don't know what your supplemental benefits are. Maybe there's some percentage cap or dollar cap on what we're willing to take risk for if we don't have any control over that benefit design. That's just from a lawyer perspective, that's a very interesting concept that I hadn't thought of before.
Another interesting concept is, these are benefits that are all approved, blessed by CMS. And, if a provider wanted to offer these types of rewards or benefits themselves, they would have to go through their own, legal analysis and figure out how to do that, in compliance with steering laws, et cetera. So just the fact that this whole benefit framework exists that is designed to help members and patients, and there are providers that don't know about it, it's really frustrating and seems like an easy place for some education to happen that benefits everybody.
Absolutely.
Let's shift gears a little bit and talk about risk adjustment. We talk about risk adjustment a lot, but there have been a lot of recent developments, expansion of RADV audits, changes to the model, not as many as were proposed at one point, but some changes. And then a court ruling invalidating extrapolation, and that's under appeal. What do you think, Brandon, that with all of this in flux, what do you think Medicare Advantage plans should be focused on in terms of risk adjustment?
Oh, there's so much. Let's start with RADV first. And, the onslaught of RADV audits and auditing every year and this sprint to catch up on audits is just putting a big operational strain on health plans and providers. Because though it's not a huge sample, it just means every payer is paying the same provider for a handful of charts, and it's a big logistical, administrative effort that has a very condensed timeline. So plans have to be very well staffed and very coordinated when how they're balancing the work on RADV while still driving their prospective programs or retrospective programs and their submissions. So you have to have a really strong team that is balanced across the current status quo work and the incremental work from RADV. In terms of the extrapolation, the guidance we've been giving clients is, treat it as if it were being extrapolated in terms of building that muscle of applying the analytics to understand the population that has been selected and what your overall risk exposure is, being very dogged in getting absolutely every medical record to substantiate the conditions for which are being audited. Because if you don't get the medical record, it's an error and it factors into your overall score. And then really build that review process on the clinical coding guideline piece, because you can only submit 2 charts per member HCC that's being audited. So try to get 100% and, again, act as if it is extrapolated. I say all that to also know your financial exposure without extrapolation isn't incredibly high, so you can't overspend in this area. But with audits being every year, it's the right time to build the muscle now.
A big change that we have been talking about is CMS, finalized in the final payment notice, its proposal to exclude unlinked chart reviews, exclude diagnoses from unlinked chart reviews from risk score calculations for risk adjustment for Medicare Advantage. Can you talk about the impact of that decision and the differences between retrospective and prospective chart review activities?
Yeah, absolutely. So we analyze kind of our Pareto community, so all of our MA clients, and the overall impact was right in line with what CMS estimated and published, which I think was around 1.5%.
Mm-hmm.
Keep in mind that 1.5% assumes 100% of unlinked chart reviews cannot be linked and would not then be submitted. So I view that 1.5% to be the top end of the range, though we saw a lot of variability across our clients, some higher, some much lower. For plan,
and sorry, what do you mean cannot be linked? So are there some? Can you tease that out a little bit?
Yeah, absolutely. So linking is a murky process, and there's not very clear guidance from CMS as to how exactly to do it. And if you jump to the ACA market, there's conflicting guidance in terms of, and that's a market where linking is absolutely required from some of the technical guidance that's been put out versus the IDA audit guidance of what they can substantiate during their annual reviews. And so in terms of linking, the most conservative approach is you're joining on the member, the NPI of the provider, and the exact date of service of the claim. A lot of plans apply, I would say a fuzzy range where it's, plus or minus 5 days of the actual visit, knowing there can be inconsistencies in the data that comes across. They may use the 10, looking at the medical group and not just the practicing physician, because they may have been seen by someone else during that visit. And so the application of linking is different across payers. And when it comes to historical submissions, knowing it was not an absolute requirement, some plans leaned in and said, well, we're just going to be conservative. We're going to try to link as much as we can. Others went through a good faith effort, but then hit a point where if we can't figure it out, we're still going to submit it. So I think you have to do a real evaluation of your practice, how you're linking, and what's not being linked today and what that true exposure is, because I don't think 1.5 is an accurate number.
I didn't understand. So this is really educational for me, and I'm guessing for some of our listeners. So not all retrospective diagnosis code submissions are going to be affected by this new policy. So if I'm a coder at the plan or at a service provider like Pareto, 4 days after a physician visit, I'm doing a chart review and I see, they didn't code diabetes with complications this time, but there's, documentation that was being addressed in the visit. I can submit that diagnosis at that time and link it to the visit. Is that how it works? Or?
Yeah. Probably 3 things to go through. So you mentioned prospective. I say concurrent, but this would be best practice within a risk-bearing provider organization where they are performing a post-visit pre-billing review of the medical record. So within a day or a finite amount of time after the visit, they're having a certified clinical coder go through the medical record and ensure the documentation and the corresponding ICDs that are going to be billed on the claim over to the payer are in line and complete and accurate. And if there's any discrepancies, they're working with the physician. So when the claim gets to the health plan, it's 100% accurate.
Okay.
The second thing that
that would be at the provider. The provider's coders are doing that.
And also on the provider side, they do perform their own audits. They will do their own kind of second level reviews, and plans have a ASM submission process, or which essentially allows a provider, after they build the claim, to be able to say, hey, I did review that medical record retrospectively. I found, these deletes and these adds, and it's a submission file that comes over. The plan has to take it in, evaluate it, and link it to a claim and submit it. And then the third category is all on the payer side, and this is the bulk of where the retro activity takes place, which is health plan led, them running their first level reviews, their second level reviews. They're chasing millions of charts, coding at scale, and linking all of those to a claim that they've already submitted via EDS or the Edge server, and getting that either accepted or rejected by CMS or HHS. So 3 different processes happening. That latter is what is the focus of this unlinked provision and the advance notice. The last thing I would highlight here, as we reviewed the unlinked charts, were we had multiple clients who, for fear of misadjudicating the claim or triggering an inappropriate copay to the member, they have all of their in-home assessments being submitted outside of their claim system. So 100% of their in-home assessments are being submitted as unlinked supplemental records, and you're not going to have anything to actually link it to. So for those plans and vendors, they have to partner now, and they have to figure out how to get those claims submitted so they count as actual claims and not supplemental submissions.
Interesting. So they could submit $0 claims if they're paid through some other mechanism.
Yep.
And then those diagnoses would not be unlinked.
Yep, that's exactly right.
Thank you for breaking that down
but
for us.
This is again, the practice of linking is murky across payers.
It's so hard for us that there isn't clear guidance about what's permissible for that kind of thing.
I hear you. Well,
would you?
I'm speaking to it exclusively from a business perspective and what we observe and market.
Yeah.
Would you be able to give a little color to the conflicting guidance in the ACA space? Because we often, in the absence of guidance in Medicare Advantage, we often end up looking to ACA just for analogs, and so I think that's interesting that there's conflicting guidance over there.
Yeah, so within the IDA guidance, it essentially stated that as long as the condition is substantiated on the medical record for the performance year, it can support the audit, which pretty much means we don't have to link on data service. We just have to have a medical record for that provider and that member within the performance year or calendar year to substantiate it. In talking to plans, some have gone that far and kind of like a tier linking approach, saying, if I can match on my Edge server ID, my NPI, and my data service, that's going to be the first level. Then I'm going to loosen up a little bit on the data service, and then loosen up a little bit on the provider, and maybe go medical practice or 10. Not a lot have gone so far to just ignore the data service, but that's where the conflicting guidance comes in to say, yeah, you didn't say we could do it this way, but we're getting audited this way, so why would we submit that way? And it's inconsistent in terms of how plans apply it in practice.
Really interesting. Yeah, and it looks like we're going to start seeing discussion, potentially litigation, where there's gray area. And, if I were talking to a plan, I'd say, take a look at what your guidance is on linking, as part of your overall risk adjustment compliance review, and have, a documented defensible practice.
Yeah,
Absolutely.
That's really helpful.
So we don't have to belabor this point, but it is, I do want to mention it because it's been such a big issue in the industry. As you know, the payment rate was finalized for 2027 this month. And although the final rates are higher than what was initially proposed, the reaction in the industry has been, somewhat tempered, given that it's effectively a pay cut when you consider how much the cost of medical costs has risen over the last few years. So can you give any color to, how your organization or your clients are responding to this announcement, or what are you seeing across the industry, in light of the flattening rates?
Yeah, so to your point, the final rate was more favorable than the advanced draft notice, and it usually is. Our clients are viewing it more as an offset of losses than additional dollars they can use to invest in benefits. And so, to your point, the higher than historical utilization trend on Part C, the increase in cost on Part D with the IRA, plans are financially strained right now. And so we're not seeing a lot invest in benefits, sub benefits, as we were talking about previously. It's much more of an offset to losses.
Thank you. And with that, I think it makes sense to talk about star ratings. That's, another source of revenue in the Medicare Advantage program. It's also another program that is undergoing quite a bit of change. In the final rule that came out this month, CMS eliminated the Health Equity Index. It removed a number of administrative quality measures that a lot of plans have invested heavily in. So I was wondering if you could speak to how the changes on the star rating side are impacting the work that you're doing with Pareto.
Yeah, a lot of change. On health equity, we first just renamed it and then we got rid of it. So it's interesting on that front.
Excellent health outcomes for all.
EO for all. It didn't roll off the tongue.
Made it 1 year. With the new name.
It's an acronym. I'm fine that they are retiring. So I think keeping the reward factor is a net, a positive for plans, but CMS has made it very clear they are making it harder for plans to achieve 4+ star, and a direct attempt to save money for the Medicare trust. And so they're not hiding behind their objectives. And in terms of the measures they got rid of, some of them were viewed as like they're tapped out. Everyone does well in these measures, and on average, their average star score is higher, but there is greater volatility when you look at kind of the standard deviation across payers, which means plans are losing measures that had a high rating, and the ones that are left have a lower rating and a tighter standard deviation, which means the variability across payers is less, which kind of translates into these are measures that are harder to move. So with less measures, each measure is now more important, and you are left with more clinical based and health outcome based measures that are harder for health plans to influence and achieve a higher rating. So for a lot of our clients, especially back to the financial challenges of MA plans and everyone cutting back on administrative costs to offset any financial losses, typically star and risk adjustment are two areas that can avoid some of those costs, those cost cuts, but we continue to see pressure across both. So with administrative and cost pressures, plans have to strategically focus on the measures that truly matter, that are going to get them to that next half star. And so this is where Pareto's leaned in really heavily into the analytics to help be much more probabilistic and predictive, to say across all the measures, we'd love to focus on all of them, but we can't. So what is the strategic path that's going to get you from 3.5 to 4, or 4.5 to 5? Which are the measures, which are the providers, which are the members that truly matter in order to get there? Because I do think a lot of STAR leaders cast a very wide net. They want to focus on everything, and clinically we would love to. But operationally and administratively, it's just impossible to kind of achieve 4+ rating across every measure. And it's a mindset shift that plans have to go through in order to align on what that strategy is and where they're going to place their bets in order to achieve a higher STAR rating.
That's a really important point you raise about the resource constraints, and it dovetails with something that we're advising clients for their compliance programs with those administrative measures, some of which were very compliance focused. So appeals timeliness, appeals overturn rates, customer service, hitting the regulatory requirements for customer service. The CAP, it was more indirect, but the CAP survey of member satisfaction, those things coming out means that if you were relying on the STAR rating monitoring, for some of your compliance monitoring, you're going to need to think about how you're going to backfill that in this environment where there's no carrot anymore. There's just sticks. It's all sticks. So yeah, it's a big change in terms of
you can't fully back off of those administrative investments because it's just going to show up in your CAP survey. And beyond STAR, it can also just show up in your ability to retain the membership. If you have dissatisfied members. So
for sure.
You may not have that direct carrot, to your point, on achieving a measure that's going to contribute to STAR, but you have to think about it a bit more holistically.
Yeah, totally agree. Definitely agree. I was wondering, Brandon, is there anything that you think should be done? There's still RFIs outstanding on, STARS and risk adjustment. Are there any reforms that you think would be beneficial, to the program and to beneficiaries as well?
Yeah, it's a great question. I think, and I'm probably going to focus in on risk adjustment a little bit here. There's always been a lot of noise around in-homes and whether they're going to be allowed from a risk adjustment perspective. I don't anticipate CMS going so far to eliminate it, especially with access to care issues. I think care in the home is a critical aspect to the overall ecosystem for Medicare Advantage. But tying some greater coordination of care coordination efforts to it, I think makes a whole lot of sense. There's a lot of vendors out there that kind of tout quality, but it's really a risk adjustment program, and it's not a well coordinated activity to achieve kind of the medical cost savings and care benefit for the member that it absolutely could. So I do think addressing something in that space could benefit the program. There's greater conversation around alternative risk models, whether it's what Adam Buller put out in Health Affairs years ago, or what you're seeing in terms of the inferred risk model on the ACO side. It's an interesting space. I mean, at the end of the day, we're just trying to align the financial payment to the payer to mirror the acuity of the population for which they're managing. it's going to be interesting to see how far the administration decides to push risk adjustment in a different direction. Because right now, everything's been a bit more on the fringes.
That's a really good insight about the in-home visits and care coordination and follow-up. And one thing it triggered in my mind, that the new behavioral health star measure that goes into effect for payment year 2029, but they'll start collecting data in 2027. So there's not a long runway to get ready for it. And it's going to be challenging because it requires screening of the whole membership for depression using an appropriate instrument, and then for positive results, some kind of follow-up care within 30 days. And it seems like that would be a good model to use if there's a new, getting back to the in-home assessment, if there's a new diagnosis collected in an in-home assessment, you could have a requirement that within some interval there be follow-up care, related to that newly assessed condition.
Yeah, the practicality, I think intuitively it all makes sense. And for STAR, we have kind of the 2-year look back between the performance year and the year for which it's impacted. And you do have that 13 months for risk adjustment, but administratively, you have to solve for the care that gets delivered in December and how long is that coordination. What if the member is not a member coming January 1?
Yeah, absolutely.
And if you extend it out to say that coordination has to occur within 6 months, what does it do for the payment cycle and just the cash flow implications for a health plan?
Yeah.
And so all that has to be factored in terms of creating a model that are, it sounds like myopic and just the minor details, but I think it gets really complicated.
Yeah, you're right. Devil's in the details.
For sure.
Yeah.
So we've given a lot of airtime to Medicare Advantage, and we thank you for that. I do want to give you a chance to speak to, is there anything else you're paying attention to in the government program space? There's been a lot of changes on Medicaid. I know, we've spoken about ACA. Is there anything else you want to make sure that we cover today?
Yeah, I think for both of those markets, it's just eligibility and access, as both are restricted across CAID and the ACA. And with the enhanced subsidies and the ACA discontinuing, it was initially touted that the impact of membership wasn't as great through open enrollment, but we don't truly have the final numbers until members have to start paying premiums. And so what we're starting to see and hear from our clients is a lot of disenrollments in Q1. And so I'm really focused on what is that true steady state population for the ACA, because without the additional subsidies, it's just financially not a viable option for so many people, which doesn't leave them with a lot of great options either. So probably a little frustrated in terms of when that conversation started and what got so much airtime in the news, because it was weeks before open enrollment even started. And plans had already submitted their benefits. A lot of them had 2 filings, one with and one without. If we're going to make changes to the overall financial construct of these programs, they have to be made with 18, 24-month lead times for plans to actually strategize and put an effective program around it. And we just haven't operated in that space yet. So I'm curious what the administration decides to do as we look towards 27 and 28 with the ACA market in particular.
And I'm wondering if we'll see a lawsuit similar to when the government changed the rules on risk corridors in the ACA programs without sufficient notice, and driving a lot of the co-ops out of business. So I think, we'll probably need to wait on final numbers before any of those suits go forward, but that'll be that'll be interesting.
Yeah, but like the 3Rs in those suits, they didn't settle quickly. So
No, the plans won, but it took years.
The damage was already done, especially to the co-ops. I mean, all of them, except for one now, one or two, still exists. So,
yeah, something I've been thinking about, Brandon, that you might have thought about as well with your provider practice is risk adjustment is popping up in other contexts. So I saw the announcement that CMS for Original Medicare is going to be expanding its demonstration for joint replacement comprehensive care nationwide, and that risk adjustment is part of that program because the case rate for those procedures is affected by risk adjustment factors that are, patient specific. So, I'm just seeing a lot of concepts that originated in Medicare Advantage that get, spread across the health system. And I wondered if you had thought about that, or if you have any providers coming to you for things that aren't necessarily in the Medicare Advantage context, or if you think they might in the future.
Yeah, absolutely. I think CMMI has used traditional Medicare in the, whether it's the Next Gen ACO program or the ACO REACH program as, testing ground for new ideas and new innovation before they get applied over to Medicare Advantage. So having risk adjustment in that space isn't new. The application you're talking about is a bit bespoke and innovative and specific, but we continue to kind of hear that across, I'd say, the larger system clients that we have versus the delegated primary care type organizations that are taking risk, which is who Pareto works a bit more with today.
Interesting.
But name risk adjustment continues to be the name of the game and the focus.
Yeah. So, we have a number of lawyers that listen to this. What do you want healthcare lawyers to know about what the work that Pareto is doing? Or, what do health lawyers need to know to work effectively with you?
Yeah, I mean, I think compliance and the legal scrutiny on risk adjustment isn't going away, and it's probably only going to increase, especially with the increase in RADV audits. And if extrapolation somehow comes back into the game, that's going to help, not help, but it will definitely intensify the overall temperature around the legal side of this. So in terms of how we work, whether it's with internal or external counsel, a lot of our work is done under privilege. And so we typically get brought in to help understand the overall risk adjustment program, apply analytics to truly understand what the true exposure is. And we have certified clinical coders on our team to help navigate and really understand the complexities of the medical record and the documentation side. So it's a space we're very familiar operating in, and one that, frankly, we expect to have more work as, again, the regulatory and the legal side just continues to intensify.
That's helpful. Thank you.
Of course.
Thank you so much. It's really been very insightful for us to hear about your perspective on all of these issues.
Of course. I appreciate it. Thank you for the time.
Yeah, I hope you come back.
Absolutely. Love what you guys are doing.